I'm going to assume, yeah, there we go. Now we're recording. And it's October 30. I'm Tim Quast, and market strategist Brian Wilson is with me as well. Welcome to the Edge Live discussion. So back to Steve, back to your point. So we just before I hit the record button, we were talking about this impending change to the definition of a round lot. It goes live Monday. And so this was, it was a long time in the making, and parts of these finalized rules are the SEC is being sued over, so it's not a complete implementation, but this part is going through. So it has always been that a round lot is 100 shares, meaning that if you're going to make a two-sided market, a bid and an offer, that you have to quote in 100-share increments. So 100 shares at the bid, 100 shares at the offer, and the requirement is that that be automated. The market is an automated market. And if you put in an order like I have routinely done for 99 shares in things that aren't as liquid, at the market, somewhere between the bid and the offer, I can be marketable. It could be a marketable limit order, meaning I know the bid is here and the offer is here, and I put mine in between them. If it's 100 shares, it gets filled instantly or less. So that now changes. The SEC has decreed that if you have a price of $250 or less, a round lot will still be 100 shares. So now you got to check the price. Though it'll still work, the 99 share rule. If you want to look like an algorithm, do what the algorithms do, right? They break trades into tiny pieces. The average trade size in the S&P 500 right now is 80 shares. Right, so they're all getting fragmented, and you can probably see it. I will put trades in, and it ends up in 15 different trades for 4 shares here and 17 shares there and 50 over here, and then somebody had a lot and it was 295 over there. So that's algorithmic trading. That's the constantly changing price. Now, $251 to $1,000, a round lot is 40 shares. You try to fill greater than that, might not happen. You might get a partial fill. $1,000 to $10,000, 10 shares, and $10,000 and higher, 1 share. Well, there's only one stock that applies to, BRKB. But we'll now have a round lot of a single share, BRKA, not B. But there are only, what was it? I haven't done a recent count, pretty easy to do with Edge. Call it 206 stocks that will have redefined round lots. All the rest are fine. Most of the stocks in the market are under $250. The average price in the S&P 500 is, call it 230, I would say. That's about where it is. I think that factored in, right? They look at all this stuff in making these determinations. But you're right, Steve. Now you got to do 2 checks. Check the price, because you may suddenly find that it's harder to fill those things. And I expect that the activity is going to go up. I mean, great case in point. Go look at NVIDIA when it did what was it? It was a 10-for-1 stock split. And look what happened. I mean, the trading just exploded in NVIDIA, right? So the same thing could happen if you shrink the round lot. Now you got to do a lot more stuff to get the same kind of fill. So I wouldn't be surprised to see, there's going to be more activity. The aim of the SEC is to try to shrink the spread. They also wanted to implement quoting in half pennies. Of course, the Reg MS, prohibits quoting in sub-penny increments. Now that's going to happen. I think that part is tied up in the courts yet. But these are all changes that are occurring, and you go, well, why? Well, the way that the regulators and the market makers define market quality is low spreads. They're trying to do everything they can to narrow the spread. Who does that help? Jane Street. Does it help us? I like to trade stuff with low spreads too, because you don't have to, your returns are easier to achieve. Sometimes what I will do in the daily trading ideas, I'll share, and Brian's going to go first. I'll shut up on this in just a moment. He's got important stuff to cover. But if I'm using daily trading ideas, I might on occasion do this because I like the fact that you have a better probability of a if I of a quicker return. If I buy late in the day Neo, and it's a $7 stock, the probability that there's a lot of supply and that I can get a 2% return with very little movement is very high, right? So sometimes I like to do that. Certainly when demand is rising market wide and supply is declining, it's a great thing to do. You're probably just going to mint money doing stuff like that. Low spreads. Machines make a lot of markets. They want to take a tenth of a penny. We're after 2%, right? So we're after a different purpose, and that's why it works. We're then not competing with Citadel. You try to compete with Citadel, you will have your lunch handed to you. But thank you for bringing that up, Steve. That is very important, very helpful. Okay, Brian, shifting from round lots to you, over to Brian Wilson.
Thank you, Tim. Shifting from round lots to stretched market conditions. Well, happy end of October to everybody. I've got 4 or 5 topics to cover, and Tim and I will look at the path ahead together as we normally do. I'm going to start with what I call red line conditions, and let me show you what I mean. So when we look at the broad market sentiment, and I'll take this back to a year-to-date look. So the red line here, just for review and for those who are not familiar with the product, the red line is broad market sentiment, which is 6 or above. The green line is at 4. We very rarely get down to 4. 6, we usually hit 5, 6 times during the course of a trading year. And you can see the times that it's occurred here, back in January, back in April. This was an extreme outlier, end of April into early May, July trading, August trading. So that's what I mean by red line conditions. I mentioned it in the note today, and I want to take you behind the scenes here for a moment because it's an important consideration. If you move above the red line, it basically means that there's been a lot of demand in the market. Demand has taken sentiment from wherever it was, in this example, 4.4 up north of 6. Once it gets above 6, the term I like to use is the market just becomes a little stretched. And let me show you what this looks like. This goes back over 5 years. It's data going back to the beginning of 2020, and it goes all the way up to the present. I'm not going to take you through all the data points. Here's what we're looking at though. We're looking at when the market moves above the red line and when it moves back below the red line, and then what's the market return during that time frame. So for example, here in August, when we moved above the red line, when we moved back below it, what did the market return during that period? And then another exercise I like to do is what happened afterwards. Did the market implode or did we continue on our merry way? Well, if we look over the last 5 years, 5+ years, the market returned above the red line. It's about 60 basis points. And ironically, the market return, if we look at a 2-week stretch afterwards, so in other words, once we move back below that red line, what happens to the market? We continue to move higher. So the market, basically think of it as market returns start to slow down, but the market doesn't tend to implode. And that is essentially where we're at right now, or we're getting close to it. I wanted to introduce this topic today because we're at 5.7. We probably get to the red line. I don't think we'll get there today, but probably tomorrow. So that's the trajectory right now. Once again, red line, think of it as stretched conditions. And you can see what has happened, especially during recent trading. It's great examples. Look back in July trading, we get above the red line. What does the market do? It slows down for a period of time. What does it do afterward? Well, we've been in bull markets. The market continues to move higher. We slow down above the red line, the market continues to move higher. We slow down above the red line, the market continues to move higher. Now, are there exceptions to this rule? Of course. You look at the bear market in 2022, and returns were very volatile during those stretches. Look at some of the returns here in 2022. So we were above the red line. In fact, look at that one, down 9%. So you get in the bear markets, and the averages go away because you're in periods that are outliers. So I wanted to touch on red line conditions. Also want to touch on I call it big tech above 8. And what I'm looking at here is our big tech portfolio. And when big tech gets above 8, it's kind of like the broad market getting above 6. And you can see it right now, it's up to 7.8. So we're getting close. Also, we'll note this here in just a moment. Short volumes are starting to rise. So we're up to 7, 8, probably going to get up to 8, probably today. What happens when big tech gets above 8? And I've done this exercise going back the last couple of years. And this is broad market conditions when we do get that, let's just call it everything's been gunning and big tech has been on fire, which it has been recently. What happens to market returns? Well, market returns actually slow down when big tech gets that stretched. That's the broad market average. We lose about 50 basis points during that time frame. Big tech going above 8 to going back below it. That's what these trading days signify. On average, we're talking about 4 trading days with big tech above 8. Once again, we have to ask the question: does the market then implode with big tech slowing down? Not usually. Here's the returns. 1.1%. If we take out this one right here, so this was right after the tariffs. You can see that was really strong performance. If we take that one out of the equation, there's your returns afterwards. There's your normal return for the broad market. So the takeaway here is we're probably coming up on a period where the market's going to slow down a little bit. I did mention big tech and the broad market itself. And I'll put a shout out. If you don't have some of these portfolios, I would encourage you to maybe consider them. They're really easy to do. All equity is just that. Let me show you the criteria for that one. So it's just grabbing everything, grabbing small cap, mid cap, large cap, mega cap. And it's helpful for me to have some of these different portfolios set up because it gives me an idea of, hey, is it just one part of the market that's moving a certain direction, or is it the whole market? And what I want to show you right now is short volume. Look at the short volumes that are moving higher just the last couple of days across the market. So all equity, Dow Jones, short volume moving higher. We look at large cap, higher, Magnificent 7, higher. Look at mega cap, higher, mid cap's about the only one that's not. Triple Q's higher, small cap higher. Remember last time a week ago how shorts had been getting covered in small cap, starting to move the other direction now. So just wanted to point out what's happening from a short volume perspective, and also a shout out just for, I would encourage you to create some of these portfolios. I find them helpful. You can see the same thing happening in what I call the top 15. I'll stop there for a second. I have one other topic to cover, but I just wanted to see if there were any questions that came through or need to get addressed.
No, I think you're good, Brian.
Okay, sounds good. Well, I will continue. Like I said, I just have one other topic, and then I'll turn it back over to Tim. My other topic was just our edge focus portfolios. Tim is going to touch on this as well. So this is what we're referencing here. So what you're looking at right now is our what we call our low volatility portfolio. And you can look at the criteria for each one of the portfolios. It's right here on this tab. Low volatility, here's your criteria for the names that come into that each and every day. And those that follow the portfolio, the basic format is you get an email every day telling you it's usually one or two names to drop for that particular day and one or two names to add. You'll see it in the portfolio tab. So for instance, today in low volatility, it recommended getting out of Google and picking up AVGO and Taiwan Semi. You can see, especially low volatility, it has been on fire recently. 55% year-to-date returns, S&P 500, 17 and a half, and it's just been straight up here for the last 2 or 3 months. Momentum had a period where it was a little bit more difficult. This is the momentum portfolio. Same rules apply. You can look at the criteria on the criteria tab. You can see and recognize that these are quantitative portfolios. They're going by the rules that have been set up, and each one has different rules that they abide by. Some of them you might be a little bit more comfortable with than the rules for the other portfolio. If you look at the momentum portfolio right now, we were exiting KO today and CRM and getting into RTX and Shell. Performance 45.5% for momentum. As you can imagine, it has periods where it's a little bit more volatile. You had a period here back in August where we moved from 40% down to 35, and then we very quickly, brought it back up to 50%, lost 10% again. So it's a momentum portfolio. It will have some of those characteristics. You can see we've picked back up a little performance recently. If you're not in the portfolios, and you do need to be a full-time subscriber to the service, please just send an email to myself or Tim. We're happy to get you set up, and you can follow along for 2 weeks, 3 weeks, see what it's all about, what I do every day. And if you want to just follow along, just set up a portfolio and then you can see what's happening every day. Here's the current momentum portfolio, and you can just track that. So it's okay, well, the broad market's doing weaker today. Momentum's actually, it's doing okay in a weak environment, so you kind of watch that every day, get an idea for what's happening. Low volatility has been lights out. It's going to get hit today, right? Meta's down 11%. That's going to impact today's performance. But once again, if you're a subscriber, please just send us an email, and we'd love to get you signed up for that daily email. And once again, just watch it for a couple of weeks, see what you think. And if you have anything, questions about how to implement it, either one of us is happy to kind of walk you through that.
I will just interject here and tip a hat to Candace for seeing this, because no one else did really. But you might look at it and say, well, why? Two things. Why does it keep returning to the same securities? I'll explain why. It's only math. All it is math. And why, if it's a low volatility portfolio, is it picking up things that are tens instead of fives? Well, those criteria are contingent dependencies. It literally goes and, or. So then behind the scenes, because we always say buy size. Why? Because that's what BlackRock buys. We're going to go where the flows are. So we prioritize by market cap. And so if the criteria aren't met here, it will default to the or, and it will pick up the largest cap stuff that reflect, or in this case, two standard deviations between demand and supply. And that can change constantly. That's the problem. You get any change in that, and you're in and out of Taiwan Semiconductor or whatever. That's why it's occurring. When we first ran that, the or almost never showed up. We put it in because we wanted a safety valve to say, well, what if there's no low volatility stocks? Then the portfolio won't work. Well, here in this particular phase, it's doing that a lot. It has boosted returns. I mean, certainly we did not know that was going to that it would be that effective, right? We create the math, and then sometimes the machines do things that you don't anticipate. All that they're going to do is take the instructions we give them. But Candace caught that, so she was like, "Wait a minute, that's not a 5." And so it's just doing what the logic says to do, and it's been very good to returns, but that is the reason why. Could be late stage too. I will talk about that in my segment. Did I interrupt you, or were you handing the baton, Brian?
I am handing the baton.
Okay, then I'll carry on. In that vein, let me explain what I mean by I don't know. None of us know. You don't know exactly. We do know patterns. We can continue to see what the patterns are. That was your content, right? So, by the way, if you need to dump your cash, if you think there's a caching issue, caching is a serious issue. Internally, we're seeing it. We're a SaaS cloud sort of organization across the board. I mean, we do software as a service. We have been in the cloud a very long time. We were early adopters, and it worked great. It's kind of like bandwidth. Like when you get fiber to the curb, you have awesome high-speed broadband, and then everybody in your neighborhood gets it, and it becomes a problem. Well, everybody is using caching and mirroring of content, and we're seeing ripples of issues. Will we solve it? I don't know, but it's happening. We've seen it hitting. We've seen it in our Salesforce applications, which is their data visualization tools. We've seen it at Azure. We loosely have a little bit of stuff at Amazon Web Services. All sorts of things have had issues that are related to cache. But see this button down here? If you see things that shouldn't be there, you can always go to your account, manage account, and flush local cache. Sometimes that helps. So here's what I wanted to show you. Look, those systems are designed to work that way. Redis cache in Azure is what makes stuff super fast. Unless the cache doesn't dump, then you end up with bad data. And so, we have stuff that does that, and apparently there are issues. I'm just waiting for something like that to break. But that's my nature. So here's what I wanted to show you about the end of an arc. All this data is showing you is the standard deviation of model portfolios, 4 of them, not all of them. But so this is the focus momentum portfolio. Here's what we call the 5s portfolio. It's an internal one that we run, a large cap blend, and the Take 2 portfolio. It's a manifestation of the daily trading ideas. And then we look at the standard deviation of behavior, of performance relative to SPY for each of them. And so what you see is, at the bottom, there was no standard deviation. They were all the same. And what happens is, as the standard deviation spread widens, it tends to happen at short-term peaks. It widens out, and then there's a reset. It widens out, a reset, widens out. I attribute it to what we know about how prices are set. If you've got stocks and ETFs and options, and there are gajillions of them that have to be traded so that they generally track each other. That's what an authorized participant for an ETF, that's why they get compensated. They're getting an advantage. They're not paid, but they're guaranteed a spread in effect. So I think when those standard deviations widen, things have a tendency to mean revert. And there was a massive mean revert here. I could look at this performance here and go, well, what's happening here could be worse than that or not. It could be just like this, where we're off to the races again. I don't know what it's going to be, but you can see it in standard deviation. It's just interesting. We don't have the date field in here because we didn't care. We were just looking at whether, the standard deviation widened. Well, it sure has, and it hasn't mean reverted. And so I look at that and say, well, it's risky. You could look at, let's see, where is it here? I could look at the patterns in short volume for SPY, which you can pull up at Edge. This is the exact same data. It's just it's more nuanced so you can see it. And I realize my screen is not very large because if I enlarge it, then the legend goes away. But here's all I want to show you. This is January to present, and this is the short volume in SPY versus its price. And you notice that the pattern swings have become larger. What I say about patterns, the thing I love about patterns, they're the opposite of human behavior. Human behavior is highly subjective and given to constant unpredictable change. I mean, if I look this way, what are the probabilities that I will look back? Well, there is a probability, but I might just walk off. Patterns don't manifest that way. They're highly predictive. It's what we love about periods and patterns. It's why it underpins our data. We know that if there's a steep decline in short volume in SPY, that a spread will develop and the ETF will be trading at a premium to the basket, and that's going to reverse. And the degree to which it reverses will determine how harsh the reset is. But notice how everything just mean reverts. You see it all the time. We talk about this. It's one of the things that I get concerned about in the market. It doesn't have a self-correcting mechanism. It depends too much on arbitrage. But you look at those patterns and say, well, since the bottom here, the swings in short volume are much greater than they were by a factor of 2 or 3 versus where it was here. Why is that? It tells me that the amount of activity that results in the market mean reverting, but then creating a breadth issue, is compounding. You probably saw it was widely publicized that a couple of days ago we had the worst breadth in the S&P 500 in the data set back to 1990, meaning the broad measure closed up, but it was supported by only 100 stocks. 400 stocks, in effect, declined. And we see it in the data too. Over the trailing 20 days, there is more selling than buying occurring if you look at the entire S&P 500 basket. It's meaningful, and yet the market doesn't reflect it. Will it at some point? Well, as Brian always goes to, it does not so long as the market depends on 15 stocks. If the Wilshire 5000 total market index weighted average market cap is $1 trillion, there are only 11 stocks with $1 trillion, then the market will go as those 11 go. Right? That's why we prioritize size. But I think that certainly for now, and maybe it's, as Brian pointed out, is it a 60 basis point return when you get to the end of a demand arc? I don't know, but we are at the end of a demand arc. You can see it. Broad sentiment is at 5.7. If we take the daily read, 6.1, it's already basically topped. And if you look at the supply-demand balance, this is different than this. It runs in very predictable patterns. I've said before, it's 7 to 9 days, those patterns. This was an outlier. And when you have an outlier, when it reverses, you have an event in the market. If the pattern is greater than it was before, the probability that when it corrects, that there is something severe that occurs is higher. So I could look at this and say, well, does this indicate that anything severe is about to occur? Not really, but it's a different pattern. And certainly from a demand perspective, we now have no longer divergence, but sort of in between. Well, that's the end of a demand arc. So then what would you do with that? If you're trading daily trading ideas, should you stop? Do you increase? Again, all we can do is talk about data. We don't give advice. We provide data. Certainly we believe it's very well-informed data. But, at the end of the demand arc, your risk will increase. The daily trading ideas, we still have plenty of them. It just makes you think a little bit more about that. Where we are. Everything runs in cycles. In the market, those cycles are about you look at them over time, 15 days. Why would it be 15 days? About the length of time between options expirations and month end. It's amazing how much the market moves that way. And in that vein, if I looked at month end, which is tomorrow, just back up a year and look at what happens every month end. You can pick these out by the dot here. Right? So here's options expirations. This will be, the index options expirations, VIX, and the Friday, third Friday expirations, triple or quad witching. And then here's month end. This one, it was a non-event, but it was the beginning of a plateau for the market. Here, it was the portents of a steep decline. Here, we got hammered. Here, not a big deal. Here, not a big deal. Here, not a big deal. Here, we took a little rocking. Here, we pulled back. Here, we took a little rocking. Here, we don't know because it happens tomorrow. I don't know. But they're very important. And I think all of it fits together. If you put the whole picture together, the standard deviation, the arc, the importance of options expirations, it all comes back to what the money is doing and how the stock market works. Those are the two pillars that I always return to. That if you understand, most of the money runs on models, most of the prices are set by machines. There's a tremendous over-reliance on derivatives, 20% of market cap, that at each benchmark, it matters. And so I don't know what's going to happen, but I conclude that we're at the end of some arc. And maybe it's the market returns 60 basis points, or maybe it gets clocked. I don't know. I don't look at the data and see anything terribly wrong. But I also know it's been 2 quarters since this. It takes 2 quarters generally for risk management systems to absorb and rebalance and reweight. How do we know? We see it over and over. We've been doing it for 20 years for public companies, and we see it. So we're there. I don't know. But that's kind of what I've got. Brian, you and I can tag team what's next. Questions, comments, thoughts, words of wisdom? I'm always in search of those. Then I guess we could talk about what's next. What I look at here again is I now get a little cautious about daily trading ideas. Transition. Will there be new month, new money? Is it a difficult time? I don't know. So if you're risk averse, then you maybe sidestep around those. I'm less concerned about that with the model portfolios. I do look at that standard deviation. I told you a long time ago, we look at that as a way to know when to change. And I look at that and think, man, they've delivered some great returns. I think, Brian, you put in your note that you might not add 2 positions in those portfolios till we get a better signal. I think demand needs to come down and supply needs to stabilize, and then we know things are fine. But I don't know what's going to happen, but that's an easy thing to do. Brian, what do you think?
Tim, one question from Brad regarding sentiment and SPY. Would you say that sentiment is a leading or lagging indicator?
Yeah, well, we certainly hope, Brad, that it's a leading indicator. A lagging indicator is a consequence. The way I think about it, what's the difference between a lagging indicator and a consequence? They certainly don't move like a metronome. If you tried to run a correlation calculation on those, you would conclude that it's not helpful. But if you run a lag indicator on it, you would say, well, it's pretty good at telling us what's coming. And certainly we run behind the scenes. We've never published it here. We run 5-day forecasts and correlate them. And they're amazingly good. So to me, that would say it's a pretty good predictive measure. We're always after predictions. I always want to know, well, what's going to happen? And, I get called Dr. Doom as a result of that, but I'm not. Doom, but I do want to know what's coming. So that's what I think. Bob, I've noticed that on model portfolio, but sometimes move the day they are. I know. And it's the problem with a mathematical model that doesn't have, what we could do is say, well, don't return to a security that has been in the portfolio in the last week. We could say, don't turn over any positions hold positions for at least 3 days. We could put those kind of conditions in there. We'd have to, We've chosen not to because we want it to mirror what is at edge. And so it is absolutely doing that. I agree, Bob. It's like you just bought Google and then you look at it and now it's telling you to remove it. Both Brian and I don't necessarily do that all the time. I trade notes with people about this routinely, and I've said, I can't tell you. All we can do is say this is data, and if it's moving too fast, do it every week. The probability that there is an impact on your returns is high, but it's probably not going to be significant by changing the amount of holding time. Yeah, so the same symbols appear there because there are sometimes crossover characteristics. It's the same thing that is I'm sorry, Anesh, I'm answering your question. And the question is, I see that the same symbols can appear in both edge focused portfolios. Why? Because there are overlaps in conditions. We look for liquid stocks. The momentum portfolio is certainly looking for strong demand and declining supply. A standard deviation calculation can come up with the same thing. It's a mathematical coincidence, but it could end up putting the same things in the portfolios, and that's what you're seeing. Interesting comment. I was watching CNBC yesterday, and there was, it's one of these panels that my wife Karen calls the "What do you think of this stock?" panels, because that's what they sit around doing. But that one of the panelists said, the problem for stock pickers, and it relates to this, Anesh, the problem is they don't have any choice but to own the stuff that the indexes hold because otherwise their performance lags the benchmark. So you're forced into it. And the son of a gun, you run in a quantitative model like we do, and what do you end up with? Well, you're going to end up with that concentration risk too, to some degree, because we're going to return to those things. And does that concern me? I feel better when we have a portfolio that isn't what everybody else owns. And the problem is, what causes stocks to rise? Everybody owns them. So it's the sword of Damocles situation. But that's why, Anesh, both those things are related to each other. The math may overlap, and we're going to return to things that manifest those characteristics. And it's going to be disproportionately in large caps and particularly mega caps.
Mm-hmm.
Yep.
Tim, a couple quick things to share on
Yep.
my end here.
Yep.
Joe had asked a question about passive investment flows. And let me show you what's happening there. It's a topic that we discuss periodically. I'm going to share with you a modern IR report on the S&P 500 side. Passive investment is looking fine there. Here's the 200-day average, 25.6. Here's the 20-day average, 25.9. 5-day average, 25.5. So everything is fine in terms of underlying stocks. In terms of the SPY, this was actually weaker for a period of time. Got down to 17.2. We did have what you're looking at here. If it's above the zero axis, it means greater influence from that behavior. The point is you had passive money coming back into play right after options expirations. I think that was part of the reason that we got the sudden move higher for the broad market. But in terms of passive money, it looks fine. I don't see any issues there. I did want to point out something in NVIDIA, and I'm going to share with you a modern IR report. To Tim's point about concentration, largest stock in terms of market cap. Look at what the money is doing. So this is normal active investment levels across the market. What that means is if 100,000 shares of a stock trades during a given day, about 10,000 of that's coming from active money. That's what those numbers mean. But look at the difference here in terms of NVIDIA. It's about 200 basis points higher than the broad market. So when you think about active money and how active money tends to underperform the broad indexes, what are they doing right now? They're crowding into NVIDIA to the tune of over 12% here during the last 5 days. So I just wanted to share with you what some of that concentration risk looks like and kind of what's occurring behind the scenes. In
And
terms of,
and I'm going to
go
add
ahead,
one
Tim.
quick thought to that too,
Yep,
Brian, that if you
yep.
look at there's a manifestation of risk parity portfolios in there, which is the thesis that rather than allocating, say, 60% to equities, 40% to fixed income, you make your allocations based on a risk model, so that you have that you're factoring exposure with a risk management equation there to achieve
Mhm.
risk parity. That there is lower allocation by passive money to NVIDIA, interestingly. If
Mhm.
you, as a percentage of the volume, doesn't mean percentage of ownership. We're
Yeah.
tracking the amount of volume coming daily from passive money, and it's significantly lower in NVIDIA than some other things because there's a lot of risk in NVIDIA. I mean, it can lose a lot of ground fast. And so I think that shows up in models that will then disproportionately weight to Google or whatever and a
Mhm.
trading
Mhm.
model. Sorry, go ahead.
Well, no, to your point, that's a great point. Look at intraday volatility. This number is much higher than what we're seeing across the market. So I think that's a great observation that that would mean that NVIDIA is not being included then in some of those baskets. My point ahead, I've kind of mentioned it already, but I think we get to the red line soon, which probably means that broad market returns start to slow down. Uh, do I think the market implodes? No, unless something drastic occurs. We're continuing to see, substantial strength in big tech. Back in April, when the market imploded, it was a very different story for big tech. Big tech was down, sentiment was collectively one something, two something. So it was a very different story there. Could it turn around and go the other direction? Absolutely. But for looking at it right now, I don't see a market implosion.
And Steve, to your question, which I think is the early cycle, the companies that are reporting early in the earnings cycle, do we take that into consideration when looking at momentum stocks at all? We just did. I mean, it manifests. The beautiful thing about demand and supply to me is they're already manifestations of everything. They're manifestations of how people bet directionally. Quantitative hedge funds, 0.72 Millennium. What are the big levered hedge funds doing? It's going to show up there. Um, the passive allocations, stock picking, the use of derivatives for hedging or exposure, all of that shows up in demand and supply. So we can just watch it unfold. Um, and there behind the scenes there are big bets that may cause things to perform differently than one would anticipate. You wouldn't look at Fiserv and think they're going to lose 44% of their value in a day, but it happens. So that's how we see it, Steve.